Welcome to the Dividend Talk podcast, episode 202, Quarterly Dividend Roundup. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit EuropeanDGI.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. How are you, buddy?
Oh, really good, actually. It's so nice, such a nice summer right now. So work is keeping me, to be honest, very, very busy. But it was also nice to be a bit disconnected from social media for the last 2-3 weeks. I started a little bit again on Thursday, I think, but I needed that. Every year, it's always good to have a little bit of a detox. But yeah, it's been good. It's been good. And finally, some fireworks again in the stock market, because I felt already like cucumber time came really early this year. Yeah, there was really no news almost in the stock market over the last few weeks either. So yeah. But how are you doing?
Good. It's funny. It's like a role reversal on last week. You were obviously a little bit sick last week. You've come with a lot of energy today. I can see it in your face. A big smile of yours is there, so we're ready to go. I, on the other hand, was up really late. I don't know if you what way weddings go in Poland or the Netherlands, but they're normally pretty late in Ireland. Like, people drink all night, but I wasn't drinking. I was on taxi duty, so I was just dropping people to the wedding, picking them up, dropping them home, and it was a 45-minute drive to and back every time. So a couple of journeys.
Nice. Well, weddings in the Netherlands, they end early, quite early, I must say. In Poland, it's like, I guess, when the sun starts shining again.
That's the type of weddings we like. But yes, you're right. Lots of news, and look, we have to talk about these potential, and I'm doing like inverted commas with my hands, but potential falling knives. I think one of them definitely is Walgreens is definitely a falling knife. It's falling to its lowest price since 1997. So if you've held them that long, you've made nothing in price appreciation. It's all dividend is all you've made since then.
Yeah, sure. I mean, what can I say about Walgreens? We know this stuff. We've discussed it a dozen of times on the podcast. I know you were a strong believer, I guess, because of the is it the Boots brands also in the UK?
Boots is still quite strong, but they had this Village MD and trying to connect. It seemed like a good idea, but I think the execution was poor.
Yeah, exactly. And then you took your learnings and your lessons and kind of got rid of it, right? So for me, it has written all over it that kind of this industry in the United States has had its best time. Yeah, and it's reflected in how the stock is performing, and share price in this case is also a result of that. So I don't think it's even unfair.
Yeah, no, absolutely not. It's unfair. Like, there's a clear lack of direction, leadership, management. It just seems lost, and now they're closing more stores. But I think we talk about Walgreens enough. We don't need to go at them. But I'm more interested in is Nike. We've got a couple of questions. Istein and Patrick and Adam. It's been in the news because it dropped 20%. Are we seeing a weak consumer? Like, McDonald's is also dropping all year. There's a lot of consumer brands dropping. Starbucks is another one. What's your take? I'm interested because I think you're a shareholder, right?
So let's say like that. I don't have the macro data at hand to confirm that or not, but when I read reports in general, there have been a lot of warnings about the weakening consumer, also in China, also in I said in the United States. Actually, in Europe, we see this a little bit less in the reports. Yeah, because when I read many of the quarterly reports, usually Europe is doing relatively well compared to the other geographic zones. So look, it seems so. There's also speak about Nike not being innovative enough anymore, that other competitors are eating their lunch. I mean, look, this is really interesting, right? If you zoom out, you will observe two things. Over the last 3, 4 years, earnings and revenue were rather flattish. Yeah. And if you then look at how the share price performed initially, was not reflecting that. Yeah, it was going all the way to the moon. Then, of course, reality starts kicking in. So somewhere since late last year, let's say, the share price until now has almost halved. Yeah, and for me, this is just a reverse to the mean. Now, if you then get a weaker guidance on top of it from the company, yeah, I mean then you get slashed in this market because many stocks are priced for perfection or simply already overvalued. You see this in the multiples everywhere. I mean, also, is it Pepsi a 27 or 30 multiple? Come on, what justifies that? Yeah,
Yeah,
if,
yeah,
if you see the balance sheet and an 80 something percent payout ratio. So with such companies, there should just be not how is it, a guidance adjustment or something like that coming from management. They get slashed. So for me now, Nike is really coming in this territory where it's supposed to be. Yeah. And now is the question, is it really the right value and such? So I need to do some more homework here. I do have a small position. So for people, I think now is just to do your homework. Yeah, what I can say is based on the trailing 12-month earnings, you're getting a top-notch brand in the world. I don't know about you, but my kids are still loving Nike. They want this all the time. They don't want anything else, right? So um, it has a mode from that point of view, from a brand appeal. Yeah. Of course, you can switch your shoe. There are no switching costs for you when it comes to buying shoes.
yeah.
Yeah. But it has a 20 PE on the trailing 12 months. Yeah. I know that if the earnings would go down, it will look a little bit different. But 20 in this market is really, really not bad. Yeah. Really not bad. So, I mean, for me, this is now like, look at the dividend history, 22 years of growth. Do your homework now. I will do some homework this weekend. I will then share it via email with our premium subscribers, so they don't need to wait until the next newsletter comes out. And yeah, let's take it from there. Yeah.
Yeah, this is where conviction comes in, and probably doing homework before an event like this is probably helpful. But for me, it's so funny watching social media blow up. Half my timeline is saying Nike is dead. Management need to change. I think I've seen all sorts of crazy and quite frankly stupid stuff. Right, I go to
Yeah.
call it. But look at the numbers. As you said, there is a trend that it's declining. But P ratio is 40%, dividend CAGR 10% over 5 years. We've got earnings growth at 26% over the last 5 or 10 years as well. So it has been declining over 2 or 3 years, but if you zoom out again, it's still growing. The brand for me is not dead; it's still as popular as ever. So it's just about your conviction. Is it increased competition? Is it high interest rates? Is it weak consumer? And that's just about doing your homework.
But look, if you bought Nike at $120,
It's
yeah,
crazy.
yeah, but people have been buying it around that time, thinking
Yeah,
it will go to the moon, top consumer brand. That was the whole narrative. Yeah.
yeah,
And we had this question often on the podcast, and I always said like, well, low 80s, I'll start looking at it. Yeah. So all I'm trying to say is like, if you buy such a stock at a 35 PE, yeah, no wonder that if there's but people should never forget these stocks are consumer cyclical.
yes,
These are stocks that are sensitive to the economic conditions. If there is an issue with the economy, you postpone your purchase of a few new sneakers that you usually, if you get a bonus all the time, would just buy because you want to feel good. Yeah, but if you're short on money, you buy something else, or you don't, you postpone it. Yeah, and you focus on other things. And that's what we also see with McDonald's, dining in more, maybe, by the way, if I go to McDonald's here, it's full of kids continuously, which tells me that our future generation is doing well, and that we may also need more Novo Nordisk in the future. So all of that, I would like to say, I mean, I don't see the weakness when but again, Poland is not a major market at all for any of these companies. Yeah, they could miss it as a toothache. Yeah, but it's of course all about the States. I don't live there. I can't judge. We had a really nice post on our Facebook group talking about going into the Starbucks store, where in Europe, yeah, and this may be really interesting for our American listeners. In Europe, when you go to a Starbucks, it looks very premium. Yeah, it's really well maintained, just great stuff. But then he went into New York, and it was kind of a dumpster. Yeah, this is my experience also when I went to America in the past. If I was in a McDonald's, for instance, in Europe, it looks better. Not in every place, right? But generally, it looks much better than what I on general see in the States. So so we can't say like what we see here is a how I say it. We cannot extrapolate that to how the whole company is doing. We really need to look at the numbers. Yeah.
Yeah.
And yeah, now's the time to do homework. I mean, to your point, you had to do homework before. We did some homework before. That's why we know that around this time there's a different price point. But of course, I want to understand a little bit more the guidance, what this really means from my growth expectations and such, and therefore then to understand like, okay, what is really further worth to pay for this? Yeah, that's what I'm going to do this weekend.
Yeah, nice one. Yeah, I think I remember your fair value at the time was around 80. Mine was closer to about 70. It's splitting hairs now at the moment because it's halfway. So I think it's a good opportunity to look at them. So I'm sitting in the sunshine this week. I'm going on holiday, so I might download some of the reports and give me something to read at the pool.
Good. Yeah, and then maybe what under all this news, there's just one really interesting news that I still found. Philips. Yeah, remember that? Yeah, we had them sometimes on the stocks here on the show here as the respiratory devices. They settled. The stock popped from 15 to 24, 25, or maybe 28. It came back to 23.5. And I'm very curious also to learn from our Italian friends, because the Agnelli family, they now own a 17.5% stake in Philips. They started building it up already not too long ago, in August last year, I believe. So they're really long into this. And also they do this via their vehicle, I believe, Exor, the investment vehicle. But they are now by far the largest shareholder in the group, which is really interesting, right? I don't think they will do a takeover. I can't imagine. But it's really interesting to see how this family is really investing in Philips, and how bullish they are on the fact that Philips is a medical device company. And what for me is always in my head, I don't find, by the way, Philips a high quality business. Let's be clear, yeah. But what I find interesting is that those respiratory device issues, the stock was trading at 40 euros. It's still trading at 23 euros. I know there have been hits to the numbers, yeah, because of the settlements and everything, but I haven't got a feeling that the underlying earnings power and revenue potential has changed since then. I found 43 euro always having a lot of ID in the share price, like, okay, it's now a pure play medical device that will take over the world. Maybe that was a bit too rich, but I can see why this family, if they really have done their due diligence, may be interested in this one, because they could make a 50% profit on this one if life comes a little bit back into the share price and a little bit momentum.
Yeah, I can definitely see the opportunity, and if I had the money these guys had, I might take a chance like that too. But look, Philips is a funny one, isn't it? It still has strong brand power in Europe. Like if you mention Philips to Europeans, they will know the company. But obviously litigation and all this kind of stuff hampered it. but it's always one that I'm watching on I want them to do well. I'm probably not going to own them. I don't have
Yeah,
a strong enough conviction, but
yeah.
I want them to
But
do well.
that's interesting. Medtronics is also not doing really well.
No,
Yeah. So but I think generally pharma stocks, medtech, the big ones are currently quite struggling
yeah,
to find growth. I think the market is saturated. People can't really continue just pushing prices into the sky and pay for it, right? So yeah, interesting one. Interesting. But this family, maybe for our listeners, they have quite some good stakes in Ferrari, Alfa Romeo. They also own Juventus, the football club. So very interesting.
yeah. Okay, dividend announcements. There's been some dividend hikes this week. A lot of banks have been reporting out, but we'll start with a good old consumer staple, and that is Kroger. They hiked their dividend by 10.3%. That's a pretty big increase from Kroger. General Mills hikes their dividend by 1.7%. And then on to the banks.
Yeah.
JP Morgan had an 8.7% increase, up to 125 a share. Morgan Stanley with an 8.8% increase, and Goldman Sachs with a 9%. Some big increases from banks this week.
Yeah, and we're only highlighting them for our listeners
Yeah.
to be complete. But let's go to the real one. It's Kroger, 10%
Yes.
hike. Oh man, that's really good. And we got a question also from Maciej Machevich, and he asked like, why are we not so much speaking about Kroger? Yeah, it's rarely mentioned. Like low payout ratio, impressive dividend growth, enough room for further hikes. Valuation seems reasonable. Also because of the planned Albertsons acquisition. Look, there's nothing wrong with this company. Actually, I've been looking at it a few times already, and it's quite an interesting company. And maybe I should spend some more time, even still. Like, yeah, you know what? We live in Europe, yeah.
Yeah, that's
So for us, Albert Heijn, so Ahold Delhaize and such are much more familiar to us. So there is a bit of proximity bias, I guess, where an American would much easier look at Kroger than we do, and I think that's the only reason.
yeah.
That's the only reason,
Uh,
yeah, for me.
I'm 100% the same. Like if it's 50-50 or even 60-40 between Kroger and Ahold Delhaize, for example, I'm going to stick with Ahold because I understand them. I'm in Europe. I can go to one of their stores easily if I like. I can't go to a Kroger store. I have to fly 7 hours to get to one. So
Yeah. So that's it, and I think it's just more important to know also for our listeners that we also have these biases, right? And we are in Europe, so yeah, of course we find it easier to do a Peter Lynch like know what you own in with European businesses, yeah, or the global American powerhouses that have a lot of business here, like Nike we were just talking about. So that's the only reason, Maciej. There's nothing that we have against it, totally nothing. It seems to be a very solid business. I would also recommend many people to just look at Kroger, ticker symbol KR, and yeah, figure out if this fits in your portfolio.
nice one. So I think we'll move on to our portfolio updates. It's that time of the month. We're halfway through the year. How about that? So we've had 6 months of dividend income. So I'm excited to see where you're at. But I'll talk a little bit about what I've done this quarter. So it's been quite a busy quarter actually. I've made 6 purchases in total. I've added a couple of new names to the portfolio. Evolution Gaming was one. We had Wolf of Harcourt Street on the show. He gave us very good detail about the company. I've been following his Substack, and he actually, I don't even need to go to the investor relations because he posts everything about it. He's like my go-to source for Evolution. But I think it dropped quite recently, and it was a good time to get in. My wife also wanted to get in as well, so she added some to her own portfolio, which I'm quite happy about. So that's one that I added. The second I added was Greggs. And Greggs are like a fast food kind of chain in the UK. You won't be too familiar with them unless you've been to the UK quite a bit. But they do coffees, pastries, sausage rolls, all these types of things. And they do extremely well in the UK. Not so much out of the UK. I believe they've tried in Europe. They've tried in Ireland. Didn't really work for them. They tried in Ireland during COVID, so it was kind of a hard time. But look, I think management learned we know UK landscape. We know how it works. We know what people want, so they're sticking to that. And the growth is insane. And they're close. I think they're close to opening up 3,000. Well, they will be at 3,000 stores across the UK at the end of this year, which is insane. There were 2,500 at the beginning of the year, so a lot of growth there. Dividends have been on fire. Good dividend growth. So I've added Greg's. I obviously wrote about them in the premium newsletter as well, so you can read that if you like. And then I've added some Iberdrola. So that's a slow build, just as some diversification to UK wind, which I have. Iberdrola more into hydrogen. So I just want to have a balance of hydrogen and wind in my portfolio. Munch own machine. I don't know how my German is. It means man and machine to us that only speak English. Another really, really interesting company. A little bit richly valued, so I only added a small position, I think. But we mentioned these on the podcast maybe 5-6 weeks ago. We spoke about Autodesk and CAD. I've since found out that they are a reseller of Autodesk, but the reliance on this is coming down gradually over time. And this is because they have this really nice side. It's not even side, it's nearly becoming the main part of their business, but they have this high margin software business where they're offering their own software integrations into like the likes of CAD and different bits. And it's a really exciting area actually. And so I've added those. And then UK Investment Trust, JP Morgan Global and Growth. That's part of my high yield portion, but it also gives me exposure to companies that I will never buy, like Nvidia and some of these growth kind of stocks that I'll never buy. And then lastly, I've just reinvested some shares into Vici. So in total, it brings my positions up to 38, which is not too bad. I don't really want to go over 40 if I'm honest, but I do have 2 positions in my portfolio, which I've mentioned before from that option trade, which are down like 90% Wish and Sodo. So really I have 36 positions because they are just worthless. I look at it that time. Let's get on to the interesting part, dividend income. And this quarter has been my best quarter ever, and June in particular. So before tax, I have hit over €1,000 in dividend income. That's before tax. After tax, that's just under 900. But that's a huge milestone for me. Over first time hitting over 1,000. Actually, seeing that on your spreadsheet, seeing that like 1,000 in 1 month has been incredible. Now, of course, there's a lot of big companies, whether the insurance companies, all this month, which played heavily into that. So it's not like I'm going to get that every 3 quarters, but it's still nice to see that. And then April and May, I've averaged 430 each month.
But that's a lot already. I mean, that's like free food for you for the whole month. I mean, as a man, you don't need more.
Yeah. I mean, look, I was looking at my dividend income, and what I've earned in the first 6 months of this year is already ahead of 2021, which is only 2.5 years ago. So I mean,
look at that. I think that if we would separate our wives now and kids and you would just leave to Portugal where you can just live on the street, we could probably already call ourselves financially independent. Yeah, we would just sleep on a bench in the park, but we could go every morning for a nice coffee, look at the beach, put our towel there. We could live from that. Yeah.
I can't remember who it was. Maybe it was Dividend Hummingbird, who's changed his strategy since, but I think with their dividend income, they used to share our paddy.
Yeah.
And on that, they used to share the amount of places that they could live with that paddy. And I thought it was brilliant. So obviously the lower income states, but it was quite cool to build up like this month. My paddy is 20,000. I could live in and listing off the European countries. It was quite a fun exercise. But yeah, look, as I said, dividend income has been on fire. You can really see that compounding. The big hitters again were insurance and Shell. Were there, good old Shell. But interestingly, my largest holding is now no longer Shell. It is Agree Realty. I think the real estate had a little bit of a pop. I've been buying these guys at between $50 and $55. They popped up to like $60, I think. So they just about overtook Shell. At 7.7% of my portfolio. So the diversification of my portfolio was coming down. Remember at one time I was at 13% with, was it Altria or something like that?
Yeah.
And then my largest dividend is from NN Group. my projected annual dividend income is only 20. I say only, I mean 20% is quite good for where I'm at, 20%. And I'll let you guess what is my portfolio yield. I know you have yours reported. I did show mine.
Around 5%.
Five
But it
points.
went lower with your latest acquisitions, I think.
Yeah, 5.4% of this. So
Wow.
it's getting lower.
Nice. Well, it's really, really nice to see. And you added a lot of European stocks, from what it seems. And do you have an idea about your currency breakdown for your portfolio? How much do you have in USD versus euro and other currencies?
Oh, I think I'm 60-40 European. I'm more European based than US based.
Okay. I'm a little bit more US based, but I guess it's like the way around, like 60 or 50 maybe. Yeah. I bet 20% putty, that means 1/5 of your expenses are covered.
Yeah.
It's recent, and you're reinvesting that now. But I mean, for that money, you could already go on the vacation for the rest of your life. It's paid by dividends. Yeah. So you could start working 4 days a week now instead of 5 days a week, as an example.
I mean, it was crazy because this month, obviously close to €1,000. It's like an additional month of income on what I invest in. Nearly, not quite, but like I can really start to see that I could buy a substantial amount of shares with this.
Yes.
And it's actually quite exciting when that happens.
Yeah. Did you hit the 100K already?
No, it's I haven't.
Where are you?
I won't say on here, but I'm close.
Okay. Oh, good. Okay, well, no, very inspiring, Derek. And what I would recommend to track is also how your putty percentage is changing over the quarters, because it will give you a really good insight in how it's growing. Yeah, if it's because, for instance, I will show you later. I'm now more in the second part of going to the 100%, right?
Yeah.
And the numbers are much bigger now because the dividends reinvested and everything. So the putty grows so much quicker, and this is very motivating.
Yeah, I track that. So what do you think I was this time last year?
17, 16?
16.12.
Yeah. So 4% added, which is strong.
Yeah.
If you do it next year again, it's like 20. Let's say it will be around 25. The year after, about 30, and that's already 2 years from now. And you're now how long busy? 4 or 5 years on this? Yeah. Because I'm 10 years on this in September.
Yeah. Let's get on to your numbers. We'll see how compounding works when we see your numbers.
Good. So look, I bought 3 times Starbucks in the last quarter. I think about each month 1 time, but not in big chunks. I'm dollar cost averaging into this. So Starbucks is for me a potential large position. So I'm just slowly building up my position around these prices. I bought some Hershey. Here I bought quite an extensive one, a large chunk, because I reinvested most of my, I believe it was Meta that I sold in Q1, but I didn't deploy the money yet. Not all the money yet. So most of it went into Hershey, if I remember correctly, which I'm really happy with, because I bought Hershey at the time at a $100 share price at a 2.75% yield, and now I bought, I think, around 180, and kind of doubled my position or even more, because for me Hershey has always been the stock, like it hardly ever trades around 2.75% or more. It's always richly valued. So I used really this narrative around the cacao prices as an opportunity. Okay, this may just happen once in 5 years. So let's buy a decent chunk again, because I really believe in this business. I know people are worried about cacao prices. I'm actually not, because cacao prices hits everyone. And I mean, if I see the chocolate consumption, I don't think that people necessarily stop eating chocolate quickly. I think there is a lot of like cigarettes. The hikes will not lead to so much decline. Where I'm more concerned is the competition. Our kids are growing up with Mr. Beast as an idol, and he has his own brand here, with chocolate. Insane prices, by the way. 5-6 euros for one chocolate bar over here in Europe. Yeah, that he does. But he's also gaining shelf space. So that's where my concern more is. And Hershey has some work to do there. Yeah. But still, I'm very much into them. And also Brandon, who he's from the Stock Selector as well. He puts sometimes those pictures
Yeah.
also on Facebook. Also very active on Twitter. I really recommend to follow him. I know he's visiting this place. He was telling me that he's going to visit the Hershey factory and RSIT campus and everything. So I'm so jealous, but I know now where it is. So maybe one time, if I have an opportunity, I will do something similar.
Yeah.
I bought some Johnson & Johnson again. Johnson & Johnson will be dead money for the next 2-3 years, I think. Yeah, to be clear. But yeah, dollar cost averaging into a AAA. Let's remind ourselves, AAA company. Legal & General, I bought again. I mean, it was just an opportunity I couldn't refuse at those prices with that yields in the insurance business. For me, enough upside potential. I couldn't opportunity I couldn't refuse. And this balance is also like more the high yield with the lower yield, which I will come soon to. I bought some more Agri Realty. Why not? Yeah, high quality. I bought some more Evolution again. It came down again, so I bought some more of that as well. And I bought some Nike actually. So this balance is then nice, like low yield, high yield, nicely together, and which comes then to probably an average yield of 4% on this or 3% on this. So very happy. And I reinvested my Shell shares because there are a few stocks that I can actually reinvest on Interactive Brokers because they're in the UK listed. And Shell's one of them. So, I mean, yeah, this is such a nice stock for me. I mean, the dividends, and when you can buy a few shares straight away just in a single quarter because of reinvesting, it makes me so happy. Yeah, it makes me so happy. I feel like a shareholder of Shell instead of a shareholder. Yeah. Now, I did sell in Q2. I see it now here, Meta, and I sold Anagas. No, I didn't. Sorry, those were in Q1. I didn't sell anything in Q2. Now, when we then look at the net dividend income, year-over-year growth I track. In April, I had 100% growth compared to the year before.
Wow.
But in May, I had a 20% decline. April is a relatively low month for me. May is a much better month. So I had decline because one dividend was falling into April or two, but really big ones. And in June, I had an increase of 60%. So again, not all dividends were paid in May compared to last year here. But on average, my net dividend income, so after tax, grew by 24% year over year. My portfolio yield went down from 3.98% to 3.84%, and that's because my portfolio value has been really much rising in Q2. There were really the earnings reports did really well to my holdings. Like for instance, also HPQ, Microsoft, Shell. These are all top holdings for me. Upfi, they've been all on the rise in the last quarter, quite significantly, some of them. Even Danone, was right. And this is, I think, in the end, the result. What's the issue? Often for me in the years like 2021 or when all those stocks are on fire and everything, most of my companies lag. But here, when people start to kind of rotate into dividend stocks and everything, it does my portfolio typically well. So it's really like counter-wise how my portfolio works. Like in the good years, I underperform, and in the bad years of the S&P 500, I outperform. That's how it typically goes, which gives me also good comfort over those years because I sleep much better with that. I simply have a defensive portfolio. Portfolio growth quarter over quarter was there for around 6.5%. Information technology continues to be my largest sector, 19%. It was 18.6. It is just like capital appreciation. My largest shareholding continues to be Shell, 7.2% now. So yeah, and maybe another statistic, my PADI grew by 5.7%. So it shows that how I said, the capital appreciation was outpacing the additional dividend income projected one. But of all the money I invested, and in Q1 last year, in Q1 I kind of underinvested compared to my goal, but that was because of the sales that I was doing. Yeah, so then the numbers look like, if you deduct the sales from the buys, it looked like less. So, and this capital went a little bit into here, but like you, this was by far the best quarter. Based on this quarter alone, I could nearly, if this quarter would be each quarter, I would be really close to financial independence.
Yeah.
But 25.4% of my investments this quarter were reinvested from dividends.
Yeah. You're saying you're really close. You're really close already. You're over 66%. So you're 2/3 of the way to financial independence. That's amazing.
Yeah, and I must say that this is like probably how they call slim fire. Yeah, this would be like dividend expense break-even point. That's what I consider financial independence, right? So the question, of course, still is like, will I go at 100% or will I build a margin of safety? I don't know yet, because also in the background is like, I actually like my job. So, but I'll get to that thinking more when I'm around 90%, I think. I'm not in a hurry. I'm not in a rush at the moment. But yeah, to your point, last year I was still below 60% at this time. Yeah, so also for me, we spoke about 16 point something to 20 now. For me, it probably went from 57 to 66. So I'm kind of adding 10% per year. So if I'm now there, then I think in the next 3 years I will reach this 100% milestone.
Yeah, pretty awesome update, buddy. I have to say, and it's quite clear you don't give a shit about the macro environment, because you're buying a lot of what we see with these consumer staples that are weakening, perceived to be weakening. Hershey's was a big one, Starbucks is another one, and now you're adding Nike to it. So
yeah, because I'm not good at macro, so I worry. What the issue is, I'm buying from people that are heavily in a loss and that are dumping it. So how does Warren Buffett say it? It's a transfer of wealth from the impatient to the patient.
Yeah,
I feel that I'm doing this. Like I was not buying Nike at $120. Yeah, I felt like great company, great business. We often get questions on the podcast, but no, too expensive. Yeah. The same with Starbucks. No, I'm not buying Starbucks over $100. Yeah, no. So, and I'm not doing that. I'm not buying Hershey at $250. No, of course not.
It does show a little bit though. If you wait long enough, no matter how good the company are in a moment, you will get an opportunity.
I've been waiting for Nike for 7 or 8 years.
That's a long courtship.
Yeah, but I always had it in my foundational list of stocks in my top 20 that I want to own it, for the long run. So to be fair, this is a really small initiating position. So it is not with a, let's go hard into this, because you asked in the beginning about falling knife, right? It may be a falling knife. Yeah, so my lesson from a falling knife is like, when the share prices are falling, maybe buy a little bit for your feeling, but don't go big into it. Let like it's really like how Peter Lynch says, let the knife fall, let it ripple a little bit, and then when the share price starts recovering, that's when you can really start properly dollar cost averaging. You don't need to be a hero on these days.
No, absolutely not. Time is on our side with stuff like that. So, no, nice update. I have to say, it's crazy. I've seen your numbers over the last 4 years and how quick. Because I know you're 5 years or so ahead of me, so I can nearly map the journey out. So it's quite inspiring. But
I can tell you, it's all about and this is what people tend to forget. It's all about doing your best at work. And I know you're doing it because you had promotion, right? Or something like that over the last few years. For me as well. If I don't focus at work doing my best, I will not grow it on the income side, because the saving side has only how is it, has only limitations. So at a 50% savings rate, I've been able to sustain that in a cost inflationary environment, because my performance at work was also supporting me to get proper salary increases. Yeah. So, and there's always my recommendation, take a job you like where possible, do your utmost best. It's not about competition or something like that, but do the best as possible that you can do. And I'm sure that someone will recognize that at the right company, and your salary will grow as a result. And if you're then able to protect lifestyle inflation, yeah, then you get to these kinds of numbers that I'm doing. And some people have a lower income job than I have. It will take a bit longer. Others will have a higher income job. It will go a bit faster. I think we shouldn't be jealous on each other here, because there's a lot to why people are. There are a lot of dynamics to and context to why people can have a certain income. Yeah, the one is just simply in an industry which is maybe not skyrocketing. The other one is maybe an industry where there's a lot of growth happening. It's not easy to change your profession if you're already like 10, 15 years down the road. So don't be jealous also if you experience that. Everyone has their own path. It's all in the end about happiness to life. And I think like you don't even need to be financially independent. But like you can now start working 4 days a week if you wanted to. You could spend more time with your kids. What is that a nice improvement in quality of life?
Yeah, yeah. It would be. Now, whether I could physically work 4 days a week would be another story. But no,
I'm sure there's a company where you could.
Yeah, no, that would be. Nice. I think 2 good updates. Dividend income keeps rolling in. You notice we don't track ourselves against the S&P 500 or any of that. It's purely on dividend income, and it is growing quarter on quarter, year on year, brick by brick. So we hope that people take inspiration and can see that taking a long-term view of this does actually work. Listeners' questions. Hussein asked us the first question, and he's asking us about portfolio allocation. So he doesn't understand why there's a big concern during the accumulation phase, because you're not actually relying on passive income to live. Why worry about concentration? It risks in sectors and companies until you have to start living off the income.
Well, it's really simple. The first stock you're buying, you're 100% invested in a single stock. Yeah. So yeah, at the beginning, it doesn't make a lot of sense. Of course not. I would say like it becomes a bit of a concern later in the phase, because, for instance, if you have a 30 or 40%, let's say you're 7 years down the line, right, and you have 30, 40% in a single sector, and this sector gets hit by a crisis, and you have faced all those dividend cuts. Dividend cuts come with capital appreciation or capital decline as well, right?
Yeah,
in principle. Then it starts to really hurt. And I think you and I both had this sometimes in the throughout, where you notice like, okay, yeah, maybe a little bit too much of invested in a single stock here, because it's hard to recover from that. Of course, by being consistent, DCAing your monthly savings, you have a good cushion there. But I would say like in the beginning, yeah, it makes no sense. But I think it's more about what is your target. And he also mentions this a little bit about. So my allocation strategy is focused on when I'm 100%, yeah, let's say covering my expenses. And I've been, and over time, I've been building towards that. So I do, for instance, what you could say is like, let's assume, just for the sake of simplicity, you want to own 20 stocks at 5,000 for 5. You can think about, okay, every time when I invested €5,000, I'll stop. Yeah, here, and I let it grow. I let it run by itself. Yeah, but let's say an allocation on the capital deployed into it, that could be a good one, because it protects you to some extent of single stock risk there. But I would just say, Hussein, you're right. You don't need to worry about it if it's not an issue for you about losing too much money in the accumulation phase. Others have a different opinion about that. For me, it matters more over time because my portfolio get larger, and actually the fact that I'm so diversified in my allocation just really helps me all the time, that if something happens in one area, I'm limited exposed, and that's what I really like, and it allows me to sleep well at night. Yeah, so everyone has a different risk tolerance, and I think that's important here.
Yeah, yeah, I think so. I mean, if you have no time limit on when you want to be living off passive income, I think it's not that big of a deal. But if you are concentrated, have 4 stocks, that's 25% of your portfolio each, right? And one of them cut the dividend. That's 25% of your income gone. It will take quite a while to get that back.
Yeah.
So it delays it. So I know I understand the sentiment. I think sometimes you can overly focus on it and say, "Oh, I'm getting 3% more here.
Yeah.
I'm going to cut." You don't have to look
No,
at
no,
that
that's
level.
not what,
You don't have to look at it at that level. But I think diversification helps retail investors basically, because their conviction might not be as strong as some of these super investors. And when you spread it, you spread the risk.
And usually what I see with, we had often this dividend growth portfolio that people shared. Many people have 30 to 40 stocks in the portfolio. So, and it's not like one stock is then still 70% of the portfolio. Yeah. So I think many dividend growth investors, by following their selection criteria, automatically kind of get diversified in their dividend stock portfolio.
Tim has asked us, how recession-proof do you think your portfolio is in a big market drop? What companies will continue to grow their dividends?
So he's asking about market drop of 50%. I think that my portfolio will then drop less than 50%. Yeah, because I think the 50% will be an average I think he's referring here, for instance, to the S&P 500. So there will be those high flying stocks that have high multiples. They will probably come down 60, 70%. I guess that my portfolio would come down to 35% maybe instead of 50%. So that's what I think about it. And which companies would continue to grow their dividends? I think almost all of them in my portfolio, because I focus on dividend safety and I focus on what would happen in such an event. I could imagine that if there is a systemic risk that some of my European companies may face regulatory issues, think about the insurance companies, that they would say like, no, you can't pay a dividend now, like what we saw in COVID. That might be a risk. But from a company health point of view and such, for the companies that I classified as dividend growth, because I didn't do Rio and Tinto and BHP, they are not dividend growth for me. I think kind of all my companies would continue to grow their dividends, or at least freeze them.
Yeah. I think my European companies are well positioned to keep them. I have to say, I have a lot of UK investment trusts as well, whose policy is clearly set out. And if they don't meet that policy, then there's a chance that they might no longer exist, and so on. But I'll get that money back. So I'm quite confident in those. Probably the real estate investment trusts in the US would probably be the biggest at risk, I would see. Particularly if we still have high interest rates, and then you have a recession on top of that. It's going to hit both ends of their income, so it would be a hard one. So those would be the.
But do you think that about Realty Income and Agree Realty?
I mean, they would be the safest, but the concern is always there with those ones. I think Vici would probably.
I would not have a concern with Agree Realty or Realty Income. No, that they own all those assets, which are supermarket chains and everything. Come on. Do you think? I think consumers will, instead of restaurants, go even more to the supermarkets.
Yeah. True. But yeah, I'm quite happy. As you said, we've adopted this dividend safety model, which is what I'm trying to achieve, and I'm slowly weeding out the crap, I would say, and adding in these companies. So no, I'm quite happy with my portfolio, I have to say.
Yeah, me too.
Yoval has asked, how do you deal with insurance companies? What metrics do you look at?
So we have done actually 1 or 2 times a whole show on an insurance company, right? I remember really long ago, Munich RE, and there we had also an episode about what metrics are all important. So some you can really look at the earnings per share. Some others you need to look at the operational capital generation. But for instance, one of the things that is really important is the solvency ratio. Yeah. So if a solvency ratio is under 160, I would stay away, preferably around 200. It just gives them, so solvency ratio is effectively how well is their balance sheet positioned. Let's call it like that. Yeah.
Yeah.
So I would look mostly at that, and then at the payout ratios, of course, based on the metric that applies to that company the most. Insurance companies' balance sheets are hard to read because they need to put all the investments and all the assets and all the claims and everything on the balance sheet. So it's not your typical balance sheet.
I recommend. I think Munich already was in the first 3 or 4, maybe 5 episodes, but
Yeah,
we might try to link back to it.
yeah.
Investimator has asked us. He's just read the book called "The Joys of Compounding" by Gautam Bard. Right, highly recommends the book. But one of his outcomes or one of his teachings in the book is that conviction is overrated and pragmatism is underrated. So he's asking you, European DJI, he knows your conviction about conviction. So what are your thoughts on his statement?
I think it's true. I think what we need to think about here is in the context. Remember in 2020 during COVID, how everyone was, all those FinTwit kiddos were convinced about everything going to the moon, Peloton and everything, yeah, which was effectively an iPad stuck on a bike, yeah, on such a yeah. And those people claim to have a lot of conviction all the time, and then I believe it's overrated. And pragmatism, I think it's the combination. So conviction for us means you must have done your homework so that you actually know what you own. Yeah, but of course pragmatism means like now the story of Nike. I don't know about you, but I feel like I have a very pragmatic approach to this. I just zoom out, I look at the dividend history. I feel like, okay, it's a 20 multiple. Will the earnings really not ever rise again? No. So I think this is kind of the pragmatism. I think it needs to be a combination, but not having conviction in your stocks. I'll wish you a lot of luck when the share price is falling. Now you can of course have pragmatism in the sense like, okay, I put such a limit order in, a stop loss order in there, but then you're just starting to trade and being a market timer. Yeah. So that's not what I feel pragmatism should be about here.
Yeah. I think you need a balance of both, not just one over the other. In my opinion, conviction, you can be blindly convicted.
There's an issue to that because we see that on social media, right? Because people take often the conviction from the share price development, over the last year. And if it has been rocketing, they think they just draw a linear line forward, and they think like, dude, this will like go 3 times in the next year. Yeah, no, that's not the kind of conviction that we are talking about. Our conviction means like, have you ever tried one of their products? Yeah, do you feel it's a good product, for instance? That's where conviction comes from.
Okay, Ian has asked us. Let me see the question. What do you think of Hawk and Taw, and how far can this rally go?
Please explain me.
There's a meme. There's a meme on some poor girl. I think you've seen it. Some poor girl made reference to this, and it's been. I've blocked it on my Twitter because it's.
But what is it?
Everywhere. She makes a reference to a sexual act on it, and it's after growing up. I actually feel quite sorry for the girl because I think she lost her job because of it. She worked in some school thing, but I don't know how you haven't seen it. Maybe because you're on your break, but it's.
Well, I don't know, but it looks like something Indian, like an Indian clan.
It does look like an Indian clan, of course. But there's a second question to that, so we'll skip the first one because I do have some sympathy for the person who that went viral on, but. He's still interested in what could happen to UK monthly REIT stock, balanced commercial properties. It is going through a strategic review. I haven't looked too in depth into them. I know the UK market, especially the real estate market, has been struggling the last couple of years, but there looks like there's signs of light finally coming from UK. So it might be worth looking into. I do have, there was a properties one that is on my list. It's gone for me as well. So there's a couple there that's on my list, but I haven't yet got to them. But I think the UK are starting to see a little bit of positivity. They've been struggling. They obviously had Brexit, which hit them hard, and you had COVID. and they've never really recovered, but it's starting to see some light. So I'll add it to the listing. I'd be curious to hear your thoughts as well. So drop me a mail or drop me something, because it might speed up my own research.
By the way, of course, I know about Hawk and Two. I just wanted you to say it.
Did I say it with a diplomatic enough?
Yes, you did.
Moyak said about French stocks, they are falling because of the elections. What stocks would you consider to buy if the sell-off continues?
L'Oreal, LVMH, Hermes, the quality luxury brands. I also like, is it Air Liquide?
Yeah.
Air Liquide. I also like Schneider Electric. Yeah, those are some top quality stocks, I would say.
Yeah. I think we speak enough about them. It's probably the usual ones. What about Vinci? You
Vinci, yeah, I'm really looking into that. So I put a little section onto it in the latest newsletter. It's very interesting for me. Here, this is where I'm still need to develop a little bit of more feeling. So I run the numbers. I looked into the business, where they earn their money. I'm very impressed with the growth that they made and how they transformed from kind of a toll road business to a global business in a lot of like infrastructure and all of this. So very impressed by what Vinci has done. And I know we got the questions sometimes in the past, and yeah, I need to sit down on this one. First Nike, and then maybe, but it's more for me like it could fit in my portfolio. That's why I'm really thinking about Vinci. It's been already the whole week in my head. Yeah.
Nice one. Lucien asked us about Chesnara. Is this a falling knife?
Well, Chesnara is not a falling knife in that sense, because it's not like declining by 10% in a single day or something like that. But the question is like, is Chesnara on the right track? If you zoom out on the share price, you will see that it has been a slight decline over the last several years, 4 or 5 years. However, the dividend yield is of course why I am invested in Chesnara. And I think their dividend is safe. So they have like 24 or 25 years of dividend growth. It's a tricky business, not easy to understand. They're in the insurance policy business. They buy insurance policies typically from the big insurance companies, and they still get like kind of cigarette butt portfolios. But they also started to build their own insurance business now in a few of the countries like the Netherlands. So is the falling knife? I don't think so. But the question is, if you're looking for capital appreciation, it has been pretty much disappointing there over the last several years.
Yeah, I think this is purely high income, buffer your portfolio kind of.
Yeah. But I'm usually also looking for price appreciation, and we are getting this, for instance, with NN Group and ASR. So it did trigger some thoughts in me, like, okay, I own Chesnara now for quite some time. If I don't see at a certain moment the share price growing, and the earnings are kind of flattish or something like that, is this then still a stock I want to own for the next 10 years? So this is what this question triggered me. I don't have a clear answer on that.
Dino has asked our thoughts on liquor stocks, currently trading at levels not seen since COVID. So he's talking about Diageo, Pernod Ricard, and Remy Cointreau. The last one I haven't really looked at, but I've looked at Diageo and Pernod Ricard, and yes, the share price is dropping on both of them. We're going through a bit of a tough time where we talk about consumers, and we talk about this. China has a big impact, and obviously people moving into more healthy options. I still think that these are really, really strong brands. If you look at those two in particular, they own a lot of brands, and I know Remy owns a shit ton of brands as well. So I'm not concerned from that point of view. I still think the valuations are quite high, if I'm honest. They were always richly valued. Similar story to what we have with Nike. You were paying multiples, which we've said this before, which we felt were never justified.
Yeah.
And I think we did a deep dive on this podcast on Diageo, and we had a similar.
And also in the newsletter, I did a story about Diageo. It's not the easy investment case. But, there is also this narrative of the youngsters are drinking less alcohol here, right?
Yeah, yeah,
And that may be true, but until they get married. Yeah.
yeah.
Then everything reverts back to the mean.
Yeah, but yeah, you've got that, but you've got emerging markets, and then
Yeah.
if you do have this recession, then people, their lifestyles change, and that could lead to
More alcohol.
alcohol consumption, which is not a great thing. But look, I think they're two really strong companies. The third one, I'm assuming it's around the same, but I'm not 100% sure. I would like to own Diageo eventually, but I'm waiting for a decent.
For me also, not
price.
at these prices. Yeah.
No. Gordon has asked us, have you ever looked at Brenntag? It's a player in the chemical industry.
Not until this question popped up, Gordon. Thank you for that, by the way, because I'm liking it a lot. 3.3% yield, check. And then the dividend growth. Wow, really nice. 12 or 13 years of uninterrupted dividend growth, a CAGR of 12%. They did a huge dividend hike in 2022. Their payout ratio policy is like between 35 to 50%. So this is something where I need to dive deeper in. Like, had they always had continuous earnings growth over that period as well, or not? Maybe for people, Brenntag is how I understand it. It's a global market leader in chemicals and ingredients distribution. Yeah. And this for me very very interesting business, because we have BASF, which is, I think, quite a different company. But I don't have a lot of stocks in this area. Yeah, so I'm always curious about this. And in BASF, I'm totally bullish. We have been speaking. We think there may come a dividend cut next year. Yeah, so Brenntag could be really interesting for me. So thanks, Gordon. You brought one onto my list that I really want to look a little bit deeper into.
Yeah. It looks like a good alternative actually to BASF, and has a lower yield. It seems a little bit more conservative with its dividend policy, 35% to 50% distribution. But yeah, I mean, it looks good on the first outlay. I have to say, in work, it's the first time I've ever seen, right? But in our materials, BASF delivered to us, right? And we there was this email communication sent around saying we can only use BASF, and I was getting excited, going, BASF, and everyone's looking at me going in the meeting, going, what are you so excited about? I used to own that company. I used to invest in that. It looked like a big weirdo, but like it was just so funny what dividend investing can do to you when you see these companies pop up. Two more questions. Lucas has asked us, if you were to pick a Canadian stock, what would it be?
Couche-Tard, what is it called?
Alimentation Couche-Tard.
Yes, because the dividend guy is a big fan of it. We have been looking at it compared to Ahold Delhaize. I think they're outperforming Ahold Delhaize a little bit. But yeah, that one by far.
Yeah, I'd probably look at the railway, Canadian National Railway. I know that does quite well, solid dividend payout, but has a high barrier to entry, but it's always been so heavily priced because of that, but look, a growing dividend as well.
Yeah.
So there's a lot of good Canadian companies actually. So but it could be one of many. Gustav, he's asked us about the Chowder rule. Is this something you consider when choosing a new company to invest in?
So yes, actually yes. What I often do is take the dividend yield and look at the 5-year dividend CAGR to see like what comes this down to. And if it's like 5%, I think like, yeah, forget it. Yeah. If you have a dividend yield of 3.5% and the dividend is growing 1.5%, no, not for me. Does it need to be 12% as according to the rule behind it? Not necessarily. I'm also okay with 10%. 12% is more like an indication of like strong valuation. Yeah. And he's also asking favorite companies that pass this rule right now. Two that come to my mind straight away are the Dutch insurers, ASR, and then they are high yields at the moment, and they also spot like a high single-digit growth.
Yeah. Those insurance companies are like unicorns at the moment. We're getting
exactly
high yield, high dividend growth. and share price appreciation all wrapped in.
Exactly.
Okay, awesome. That's the last question. Thanks so much for everyone for all the questions. I think good update from you, European DJI. As I said, inspiring as always, and we hope that our listeners take the same approach and see that consistency and patience will pay off in the end. So look forward to next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.